Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday.
This week, we're going to look at a range of data points that support the notion that we are actually at the moment experiencing faster growth and higher inflation across the globe, but particularly in the US. And that is something that we pointed out has been priced into commodity markets, equity markets, fixed income markets across the globe, rather than a stagflationary environment, which is what I think was widely feared. That is a combination of lower growth and higher inflation. We're going to start off with inflation. So far, we've had inflation prints for about 2/3 of the 50 largest countries for last month. And no surprise, inflation continues to increase. Median inflation across the globe is now sitting at 3.3%. At the end of Feb, it was sitting at 2.3%. So quite sizable, sudden increase in inflation, and it's pretty broad-based. We're seeing it across a range of countries. What's interesting about the inflation prints this time around is, in contrast, in 2022, when inflation was also picking up due to an energy shock, it was largely a surprise. What we saw back then was, in the main, inflation prints coming out above expectations. Instead, what we're seeing so far, and bear in mind it is still quite early, is that the inflation numbers that have come out, of those, about a third have been above expectations, about a third have been in line, and about a third have been below. So a pretty normal set of events. And in effect, what that means is that while inflation has been going up, it's been widely expected to go up. Looking at the US in particular, US inflation increase is now sitting at 3.8%. That was a little bit above the consensus forecast of 3.7%, and it will be uncomfortable for the Fed, who at the beginning of the year, I think, were looking at the opportunity to potentially cut, and now that's been taken off the table by these very high inflation prints, in part due to higher food and fuel, but that's only part of the story, and we're going to get into that shortly. In the interim, just coming back to the Fed, how likely is it that inflation in the US is going to get to 2% anytime soon? Very unlikely. Given the large month-on-month increases that we've seen over the past couple of months, we would have to see some quite sizable negative month-on-month prints in the near term to get inflation down to 2% by September. And we think that's quite unlikely at this point. So in effect, our base case is that headline inflation in the US is going to be above 2% for the foreseeable future. Now, the Fed doesn't necessarily concern itself with headline inflation. They prefer to look at measures of core inflation, which strips out the effects of food and energy. But core inflation too is increasing. It was a little bit above expectations and now sitting at 2.8%. And again, the Fed's target here is 2. So core inflation will be uncomfortable for the Fed. And that also indicates that inflation is likely to be picking up a little bit further over the coming few months. So the inflation story at the moment certainly is not at all one that's likely to be reassuring for the Fed. But just to make matters a little worse in the US, the PPI inflation numbers came out last week, and they were very much ahead of the consensus forecast. They came out at 6%. Now, historically, PPI inflation has given us a good steer for where CPI inflation is going to go in the next 3 months. And based on the relationship over the past 15 years or so, a PPI reading of 6% suggests a CPI reading of about 5% in the next 3 months, which suggests some quite material upside to US inflation over the coming few months. And we're looking at a range of other indicators that too suggest that US inflation is likely to continue to increase. The net result of that is, at the end of Feb, what was priced in the US was an expectation that the Fed would cut by 3 times by year end, 3 25 bip cuts. That is now completely reversed, and what's priced in at the moment is a high likelihood that the Fed hikes by 1 times by the end of the year, so a 25 bip increase. So quite sizable shift in interest rate expectations, 100 bip shift in interest rate expectations from 75 bips lower to now 25 bips higher. And it's a similar scale of change across the globe. Depending on the country you're looking at now, by the end of the year, interest rate expectations are somewhere between 100 basis points to 125 basis points higher than they were at the end of Feb. And that's one of the direct consequences of the war in Iran. We've got higher energy prices, which of course would be a burden for consumers and corporates. But in addition to that, we've got higher interest rates likely by the end of the year. What's surprising about that, given the importance of fuel in the economy and the importance of fuel in consumer budgets, is that you would expect in an environment where there's heightened uncertainty around interest rates and a likelihood that they're going to be higher by the end of the year, an environment where energy prices and food prices are going up, you would expect consumers to become more cautious, for corporates to become more cautious. And as a result, you would expect a slowdown in GDP activity. And that's not what is happening. In the US, based on the latest high-frequency estimates, GDP growth in Q2 is running at 4%. Now, bear in mind that it is still quite early in Q2, and this data will likely shift quite materially over the coming few weeks as we get more and more data. But even so, given the limited data that we've got, a potential GDP print of 4% in the US is very impressive. And in reality, it's not just the US. The latest high-frequency data suggests that growth in Europe, as an example, is running at about 2% annualized in Q2. And it comes back to the point, and the reason that markets are so elevated at the moment is this expectation that growth is still going to be good, if not accelerating, in an environment where inflation is accelerating. It's not what one would typically expect, but nonetheless, it is what the market was pricing in, and it is what is actually occurring. And from that, I think there are two lessons. One, it's not always profitable just to take a contrarian approach. Sometimes the market gets it right, and so far that's what's been occurring now. And secondly, this very strong growth and the expectation that growth and earnings growth would be strong is one of the reasons why we shifted away from being underweight to being neutral risk across the globe. And given the latest data that we're seeing, we don't think we're going to be shifting back to underweight in the near term. That's where we're going to end it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that are referenced in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.